Hello everyone, welcome back to my channel. So this video marks the end of the week number 50 in this Road to 100k Realized Return Challenge, and this has been one of the most agitated weeks that we have had in the past few months, probably only comparable to the Estee Lauder saga, but yeah, let's just get on with it. So basically, as you recall, since last week, since the last video, we set up several positions here on IWM. We sold some puts on it, and we also set up these positions on Alcoa Corporation and also on American Airlines here. And basically what we did was bought up a long strangle. So we bought some out of the money calls, some out of the money puts with an expiration date after the earnings release, and in order to not to make it so expensive, we also sold puts on each of these, but with an expiration date before the earnings. You can see here we bought this strangle over here, and we also bought here this we bought this one here, this strangle, and we also sold these puts on Alcoa, all right, Corporation, and we also did the same thing with American Airlines. So basically these are this is a strangle, all right, with a 2 size lot, and this is the put that we use sort of to finance the strangle that we put on American Airlines. Keep in mind that the Alcoa Corporation, we did this with a lot size of 5, so 5 contracts for each position, and in the American Airlines we did it with only 2. However, the positions were not well set up. I realized only later on, and they were not adequately set up to capitalize on the earnings release. And the reason for that I will probably explain in another video, because there are a lot of details and nuances that will make this video too long, and I don't want to keep this video too long, so I'll probably do this in another video. But I think there are a lot of lessons learned from the positions that we opened in this particular occasion. But nonetheless, at the end of the day, and looking here at IWM 1 week chart here, you will see that on Monday the stock came down by some margin, and because we had sold puts with a 220 strike price, which is here, we were assigned, so we were forced to buy those shares at 220, right? And then the next day, because the stock came up and recovered quite well even before the trading commenced, by the time the trading day started, the puts were already the stock price was already above the 220 price at which we bought the shares. So there was no sense to try to sell a call with the same strike price, so we went one above, and it ended up going quite well. The calls that we sold on IWM were assigned, and we managed to pocket a nice profit here because we sold these same shares with $1 more, so we pocket $700 just like that on the next day. And then yeah, we even tried to sell, we even sold one more put because we still had some money, which expired worthless with 220 put, but because the price finished the day above 221, this put expired worthless. and this is me just an attempt, as you can see here. We sold the cash covered put, the short that we bought back the put that we sold for Alcoa at this particular day, because it had already come down in price quite a lot, but still we managed to get a nice profit out of it, almost $100. And yeah, this continued on for a while. We continued to do the same on Wednesday, so continuing to sell puts on IWM. And I'm not sure if I already mentioned in a previous video, but the option chain on IWM is less deep, by quite a long margin, is less deep than it is for the QQQ. And so because of that, there are no more, after a few hours into the trading day, there are no more suitable options to trade in which we could get a good premium and we roll over the position after the first options that we sell. And so because of that, let's just say that we are basically forced to, when the puts on IWM expire worthless, or they not expire worthless, but they become almost worthless, we are not able to sell more puts. It's not worthwhile to sell more puts on IWM, because by that point the option chain is very, very shallow. So we have to transition to the QQQ, because the QQQ option chain is much deeper, even later in the trading day, and we sell some more puts out of it in order to get some more cash, more premiums out of our cash. And we did this on Wednesday, we did this on Thursday, and on Thursday what happened was, as you can see here, we unwinded all the remaining positions here for Alcoa and American Airlines. Basically, what happened was that these positions were losing money, and were losing money for the following reason: because as the time went by, the time decay was consuming the value of the options that we bought, so we were losing money. But there was not an increase in volatility, in implied volatility, that would offset that time decay. So we were basically losing. And I can show you here, for example, in the chart of, for example, Alcoa, that, let's just look here at the weekly chart. For example, we had sold calls, we sold a strangle in between 30.50 and 31, and for a while here on Wednesday the stock was exactly in the middle of the strangle, and that means that both of the options were relatively out of the money, and so they were basically they had very little value. However, and also on American Airlines, that means that because the way our position was set up, which was not good, not well set up, basically we were very close to the lower strike, and because of that we were mostly losing money, because the way we set up the position, it had a long bias. It was mostly set up to profit from rises in the stock price, but because the price was very much subdued and very close to the lower strike, we were basically losing money. However, things turned around pretty quickly. As you can see here, the American Airlines had a very strong run. It ended up 12% up on the day, just because Delta presented his earnings, released his earnings, and they were very strong. And as it usually happens when one airline releases strong earnings, the other airlines react also very strongly, because investors believe that there's a very strong correlation between airline companies. and so they predict that American Airlines will also bring very strong earnings into the public. But not only that, even with Alcoa, the position started to appreciate very strongly on Thursday. Here you will see, and because our positions at this point, because we had already sold the put, our position was much more neutral with Alcoa, because we only had by that point a long put and a long call, but our position on American Airlines was pretty much biased to the upside. And so when this strong appreciation occurred, I decided, all right, let's not wait any longer. The position is badly set up. I'm in the green. I'm earning. I'm gaining. Let's just unwind everything. All right. And so basically, as you can see, we managed to get a overall profit of $31. And in here with Alcoa, because it started to rise and we ended up basically gaining on the long put and a long, we were basically even on the long put and a long call, considering that we had also pocketed some profit with a put. I decided also to unwind everything, and we ended up with a small loss of 70 cents here, but we gained about a little bit more than $31 on the American Airlines. So we managed to make a mistake and still come out relatively unscathed, and we still got a profit, but there's some learning to do out of this, and that probably I will disclose in another video. But and then basically, yeah, we continue to accrue very strong premiums out of IWM. And on Friday, because of the announcement by the US President Donald Trump that I believe 30% tariffs would be leveled at Canada, markets were pretty much going downhill. We still sold the same puts on IWM, but we managed to stay relatively away from the stock price. So I also went a little bit more conservative, and yeah, basically it was a good move because we ended up not being assigned. We still managed to sell at the end of the close with about 1 hour or a little bit less left in the session. We managed to get also a few more dollars by selling puts on the QQQ, and because we still had some cash left, we decided to go ahead and sell a put on the ARKK, which is an ETF, the ETF on innovation, and I can show you here. This ETF basically, you see, 6 long-term growth of capital, is an actively managed exchange rate fund, invests in domestic and foreign equity securities of companies that are relevant to the fund investment team of disruptive innovation. So as you can see, this kind of ETF has much higher volatility, but it was offering quite attractive premium, and so that's the reason why I decided to go ahead. And so basically, yeah, I decided to go for it. However, probably due to the higher volatility, the put that we sold was assigned, because the strike price was at 72.50. At that time, the price was still pretty much away from it, but nonetheless, we ended up being assigned. Here you'll see this is just a 1-day graph. We sold the put more or less around here. It was a 73.50, but it went pretty much downhill all the way. It recovered somewhat at the end, but still, now we were forced to buy these 100 shares. So basically the plan for next week is to sell a call here, but as you can see, these premiums are very juicy, even though of course this is a 1 week. this doesn't offer 0DT options, but because we don't want to mess around with this kind of derivatives with this kind of in the ETFs for too long, because of the higher volatility here. And so we will try to basically get rid of this as soon as possible by using the same strike that we used before. Now, having said all of this, keep in mind that this is mark to market, so we didn't lose any money actually, because the puts were assigned. This is just the difference between the strike and the current stock price, 29 cents, which is a difference between 72.21 and 72.50, which was the strike at which we bought the shares here, as you can see, here. So basically there was nothing, that's just it. And this was probably one of the strongest weeks that we've had for a while, because considering the premium that we receive on the sale of the calls of Pfizer, which I'm going to get that in a minute, because the calls were assigned, and also the amount of money that we brought in. So I'm going just to put here 0 just to see how much did we brought in. So 77, and we basically had a profit just on premiums of $1,336, and this is not counting the $700 capital gain that we had on IWM, which is cool. In total was around $2,000 that we got just over the course of this week. So now into the elephant in the room, which were the Pfizer shares. The shares were sold, so now we only have 40 shares left, and as things stands at the moment, probably we are just going to sell these on the market next day, because we can't sell any calls on this because it's too low. We need at least 100, and we basically not doing anything with these. And so making all the calculations here, keep in mind that on April the 9th, the day that in which we had that very large loss, we subtracting the premiums to this loss that we've had, as you can see here, I'm going to zoom it a little bit more, we still came away with a loss of $1,183.93 USD. And by selling these, okay, let's go a little bit further down. So no, this is it. Yeah. So here we sold at 25. All right, we sold 30 contracts. This was assigned, and we sold these 3,000 shares with a capital loss of $1,950. All right, the calculations are right here. The calculations for the premiums were a little bit more complex, but basically what we did, I'm going to do this here, and basically we, ever since we bought some shares, and of course without discounting the fact that we still have 40 shares left, I determined the premiums by adding all of these with the necessary adjustments for the number of shares that we've had, and these as well. Well, these are from QQQ, but yeah, let's just use the filter here. Let's put everything away and focus us on a Pfizer. So using the premiums we collected here, the premiums we collected here, the premiums we collected here and here and in here, and yeah, so on these 5 instances the premiums total were $2,673.75, which leads only for these shares a capital gain not a capital gain, but the overall result is a gain of $723.75. Now, consider that we still have this loss to cover. All right, and I've made the calculations right here. So basically, we had this 1183.93. We have this capital gain in here. All right, and I'm going to show here. We would still have a loss overall of $460. I'm not going to count on, I'm not going to make anything different than before. For me, this is still a loss. However, in fact, and looking at the account statement that we have, and you will notice, and this is the cap. So let's see. So this is page number 59. All right. So page 59. All right. This is the account statement since October 21st, 2024, and today or yesterday. Why am I choosing this date? Because, as you can see here, this is the date at which we bought the first shares of Pfizer that we ended up selling now. All right, it's here. So basically, if we look at the page 59 here of our activity statement, you will see that we collected some dividends. All right, and I'm going to overlay this in here just to show you. I'm going to push this further down and to the side. Yeah, and this is the accounting of all the dividends that we collected on Pfizer. All right, and this is here. Oops, yeah. So we received on December last year 168, 172 in March, and now in June we collected these dividends. Now we need to take out the withholding, all right, which is here, right? So let's bring this to the side, and as you can see, we were withheld 50.40 and 51.6 here in March, and we also were withheld $353.46. So this is the net result that we collected, and this is the amount of dividends net that we received. So we received in dividends a little bit over €1,000, $1,060 dollars, I should say. All right, and that means that the dividends more than cover this loss of 460. That's why I had the amount in here also added up. All right, so considering the dividends, we would come out with a gain overall of $602.56. I even went to the length of if I sell these 40 remaining shares now at the current market price, which is $25.66, as you can see here, we would have a loss of about $113.60, but still, even after, we would still come out ahead of and would still keep a profit of a little bit under the 500. So but because we didn't do this with the other ones, with the other stocks, I'm not going to count the dividends. This is just for you to show that we sold at a loss these shares, but I knew that considering the